Good afternoon and welcome to the show. This is Graham Neary bringing you all the news from today's stock exchange announcements. Thank you very much for joining me. It's an enormous flow of news, so I will do my best to cover as many stories as possible, but it's almost an inhuman amount of news for one person to try to understand today. So thank you again for joining me. Please subscribe to the channel if you're new here. Please give me a thumbs up if you enjoy the show, and leave your comments. We have an early comment in the live chat from Steve, who asks, do I favor putting a stop loss on my investments? Personally, I don't. However, it is dependent on each person's investment strategy. For people who trade short-term movements and for people who use leverage, I think stop losses make a lot of sense. For people who invest for the long term without leverage, I feel that stop losses make less sense. But that's my personal view. And thank you very much for the question. Please keep your comments coming, keep your suggestions coming. Okay, so let's share my screen. As I said, we've got plenty to cover today. Maybe I'll try this layout. So let's start with a takeover, because takeovers are probably the biggest, sort of most dramatic form of news. So T. Clark is the latest company that is leaving us. This is a stock I've covered in the past. I've had mixed views on it. It's it's one of these low margin services businesses, but the management have decided that the share price does not reflect the value, and they are going to leave. So let's check it out. I think it's 160p, if I'm not mistaken. Recommended cash acquisition of T. Clark. So 160p, and it's a trade buyer. Always interesting to know whether it's private equity or a trade buyer who has spotted the value here. And it's in this case, it's a company called Regent. They will give us a little bit of background here about Regent. Regent, established in 1995, is a leading supplier of gas and metering services to industrial and commercial customers. So I'm sure T. Clark will fit in perfectly well within the wider Regent group. And in terms of the rationale for the takeover, they say that T. Clark shares have consistently traded at a discounted valuation multiple to its core peers in the public markets. They also say that the market for T. Clark shares is relatively illiquid, making it challenging for T. Clark shareholders to monetize their holdings. I mean, it's not such a small company, really. Let's check the market cap, £85 million. I would have thought there would be a reasonable amount of liquidity there, at least for private investors. I guess institutions would find that more challenging to trade. But I'm not sure I'm totally convinced by the rationale, but certainly 160p is a good price. And it's interesting that the share price seems to be trading a little higher than that. Perhaps there's a little bit of optimism that even more could ultimately be paid, although it doesn't seem very likely based on the RNS that we've just read. Hello to Phil Curtis in the live chat. Thank you very much for the comments. He asks, why do I not trade gold, currencies, and oil? Well, the reason, Phil, is that that's trading, not investing, and trading is a lot more work than investing. You've got to be very active, and I'm probably a bit lazier than that. I like to just put the money to work and and then let it work for me rather than me working for it. So that's probably the main reason. But thank you for the question, and hello. Okay, so that's T. Clark. T. Clark is leaving us, the latest company to leave the small cap UK market, unimpressed by its valuation. And I hope that I didn't contribute in any way to that with my somewhat critical comments on the company in the past. Okay, let's move on. We've got a wide range of mostly sort of mid caps and small caps to look at today. Maybe we'll hop over to Sosandar because that tends to be of great interest to many people. Only £30 million market cap today. Shares are down by 12%. And if we check out why, we've got a trading update which is only broadly in line. And so broadly in line does imply a small miss. So if you ever ask me how am I feeling and I say I'm feeling broadly okay, you will know that I feel pretty bad. So broadly in line means a small miss. And so Sosandar is a curious one because they've really done an almost you could say a U-turn on the strategy. It was supposed to be an e-commerce stock, and after several false dawns, they are now trying something else with more real life sales. But this update was pretty decent in terms of we've got 9% revenue growth, we've got improved gross margins, and we've got a swing into pre-tax profits from losses. Now, as I said, they've missed expectations most likely, but they are moving in the right direction. I would say, however, that 9% revenue growth is not spectacular for a growth stock. So for small companies where you really want to see a lot of growth, I mean, personally, I'd be looking for 20% plus. So 9% is not huge by any means, especially in an inflationary environment. With an inflationary environment, you almost want to add on inflation to your underlying growth expectations. So not spectacular by any means, and they have missed expectations, and that is why the shares are down today. They do say, however, that post year end, April trading has been strong with continued improvement in profitability, driven in particular by gross margin. And they mention Next, who they're dealing with as well. I own shares in Next for disclosure, and Marks and Spencer's. So they mentioned that they're having success with their third-party partners, which sounds good. And overall, not a terrible update, but missing expectations. And there's a lot of uncertainty there around the new strategy. Fortunately, they do have some cash. They mentioned previously about their cash balance. Will it be enough to see them through? Remains to be seen, but best of luck to them. That is Sosandar today. So let's cross that one off the list. We do have a very big faller today that I thought I'd mention. We've got Doc Martens. This one is down by 29%, and that is a huge fall for quite a big company. Market cap £647 million. So a significant fall for a reasonably sized company. And it all comes down to their outlook for the new financial year. So FY 2024 results are in line with expectations, in line with guidance, which is fine. But then going into the new year, these assumptions, their planning assumptions for the new year are, underwhelming, let's say. They are taking a prudent view, and they are expecting double-digit decline in wholesale revenue in the USA. So that is quite bleak. And then they say that it could improve. There's a possibility that there could be in-season orders, but they are hard to predict. And they also mention single-digit inflation in the cost base. So you have a terrible scenario where costs are rising, revenues are falling. If you know something about operating leverage, you know that that's terrible news. They say that operating leverage has gone into reverse for them, and that profits could fall to, I think they said, a third of the 2024 level. So you could see a fall of 2/3 in profits in the new year. That's what they say would be a worst case scenario. So, I mean, I've never seriously considered investing in this business. It's the Doc Martens brand is obviously a very famous one, but it does seem quite risky investing in a single brand. I've always been fairly cautious towards this share, and I don't think I'd be interested in dabbling in this one, if I'm honest with you. But yeah, it's who knows? Maybe it could be a recovery story in due course. But at 647 million pounds, let's check sales. We had sales of 1 billion pounds in 2023, and we had pre-tax profits that were meaningful in prior years. So perhaps we could see a recovery here in due course, but who knows? A tricky one, and not one that I personally would have any interest in dabbling in. Let's move on to a company that I do follow quite closely. Let's look at Plus 500, which had news today. I should disclose that I'm a shareholder in IG Group. I'm a long-term shareholder in IG Group, and that's a company I do strongly believe in. So you can take my comments on a competitor in that context. I've also been very bullish on CMC Markets, which has the ticker CMCX, and my bullishness there has been justified. In recent months, I have taken a bullish view on Plus 500. I think it's now reached a stage in its life where it is extremely credible. It has a long track record of profitability. But I think today's results do highlight some of the reasons why my previous skepticism was there. If you look at the new customers here, for example, the company found 31,000, nearly 32,000 new customers in Q1 2024, and their entire active customer base was 135,000. So that could be interpreted in a number of different ways, but for me, it does again highlight the fact that there is significant churn in the customer base. If you go back a few years, bears like me, I was a bear of this stock going back a few years, we would point to certain issues, but so maybe we were wrong about some of the issues, but I don't think we were wrong about customer churn. Customer churn is always visible at Plus 500. That remains the case today, in my opinion. Again, evidenced by these numbers here: 32,000 new customers in one quarter and 135,000 customers total. And you can see that the total customer base didn't grow between Q1 23 and Q1 24. Could they be hitting some kind of a limit? I'm not sure about that, but certainly growth in customer numbers has slowed down a lot over the past year. And let's look at the CEO comment here. Thanks to our established competitive advantages, continued strategic progress, and robust financial position, Plus generated another set of strong operational and financial results. And also, I should point out, they do mention that phrase ahead of management expectations a few times in today's report. We've got in this highlight section, they are confident about prospects and they expect that FY24 will be ahead of current market expectations, driven by the group's focus on deepening customer engagement, which has led to improved customer longevity and increased activity levels. So, I mean, obviously, they are keenly aware of the customer longevity issue. They know their business better than everyone, and they know that customer longevity is a key metric, and they are trying to improve it. So I see it as a marketing machine, this business. I see it as an extremely effective, extremely successful marketing machine. They are able to recruit new customers on a regular, constant basis. They make significant money out of those customers, but they do have to recruit new ones always. It's a constant churn issue. But they generate enormous quantities of cash, and that cash is something that they've returned to shareholders. I would never argue that this company is not run for the benefit of its shareholders. I think it most certainly is. You can see that this highlight here points out that they returned $365 million to shareholders in dividends and buybacks during FY 2023. They have been incredibly successful at sending cash to their shareholders, buying back their shares. You can see the share price has made good progress, and the reducing share count, I'm sure, is a factor in that. And the huge cash balance that they tend to hold is an important part of their risk management strategy, because I don't believe that they hedge customer trades in the same way that other CFD providers do. So that is just my point of view there, that they need the cash in order to potentially pay for customers who might make winning trades, because the trades have not been hedged in the way that other providers do. Look at this point here: customer trading performance, gains and losses on customers' trading positions. So let's see where it says this. Yeah, look at this now. This is a key part of the story here. Customer income, and we've got customer trading performance in Q1 of $30.6 million, and in Q1 2023 it was $50 million. So unless I'm misinterpreting it, the company has made $30 million from customers losing trades, and they made $50 million in Q1 of the previous year from customers losing trades. And that is why the bears, such as myself, would rather rudely refer to this company as a bucket shop. Because if you've ever read Jesse Livermore, Reminiscences of a Stock Market Operator, and if you read about how people used to gamble on shares back 100 years ago, they would go into these bucket shops and make bets on share prices, and those bets would not be hedged. And so the bears on this stock would refer to this as a bucket shop. But they have made so much money from customer losses. It's remarkable. And this is why you do get some customers start to worry about this issue. But from a plus perspective, it's worked very well, and they always make this interesting point that they expect customer trading performance to be broadly neutral over time. However, I don't believe that's the case. I believe that customers are consistent losers, and that customer trading performance is over time very positive. Anyway, let's leave that one there. I'm bullish on Plus, despite anything I may have just said. I think that it's a successful business, and I think it's a winner. And I say that as somebody who is an IG shareholder. I respect what Plus 500 have done. Okay, let's move on. We've got plenty to look at. Let's try Ashtead Technology. So this is a spin-off from Ashtead. So Ashtead, a very successful long-term compounder, and then it spun off this subsidiary, I guess. However, it looks as if the share price here may have run away with itself and leapt up too far. You can see it's down 13% today. Decent sized company, market cap £530 million. And this is these results are pretty good, I have to say. These are impressive numbers. Revenue up 50%, adjusted EBITDA up, looks like 82%, operating profit up 76%. Brilliant numbers, achieved using only modest leverage, 1.3 times. As I've said repeatedly, I think that this is a reasonable type amount of leverage to use for most companies. And look at this return on invested capital, 28%, significantly ahead of the cost of capital. Full marks to the company for reporting this number and using it as a metric. I think all companies should, more or less. So this looks to me like it could be a very high quality company, and these results are excellent. However, the share price may have got slightly too far ahead of itself, and that is why the share price is down today. The outlook statement seemed pretty good as well. I mean, there's nothing, I don't see any major issues here in the outlook statement. It all seems fine. They are growing employee headcount significantly, and they're looking at growth in the offshore renewables market. So this is a subsea rental company, and I would point out that these numbers are not organic. There's acquisitions involved here. Let me just do a Control F on organic. So we've got organic growth of 35% in terms of revenue, M&A contributing 17% of revenue growth. So just worth pointing that out. It's not a 50% organic growth rate. Always good to know that. For the outlook, they're targeting low double-digit organic revenue growth in the medium term. So I think this is probably a very high-quality company. I haven't studied it in great detail, but Ashtead it has been an incredible winner in the stock market. Ashtead Technology looks like it could do the same, perhaps, but it may already be priced in. So I'll leave that one there. I should go back. We've got another question in the live chat. Please do give me your questions and comments in the live chat. I appreciate it very much. And on replay, I always go back and check comments on the replay. So Steve in the comments asks me, do I think there is still value investing in CMC now, or do I think the majority of the upside has already happened? Well, the CMC share price has more than doubled so far this year. So I think the easy money has probably been made. That would be my personal view, because when I put it on my best ideas list on Stockopedia, it was trading at, I think, possibly a discount to its book value, which was tangible book value. So you not only had an incredible opportunity from balance sheet valuation perspectives, but you also had the earnings upside, which seemed quite possible. This company has extreme operational leverage because revenues are volatile, costs are a lot more fixed. They actually managed to cut costs in a surprising way by reducing headcount a lot more sharply than people would have predicted. So look, since it's more than doubled, Steve, I have to answer your question by saying that I think the easy money has already been made, but I remain bullish on it. I'm not changing my stance. But in my opinion, and I may be wrong, of course, always do your own research. In my opinion, the new valuation at CMC, it does price in some decent performances over the next couple of years. It does require a decent amount of trading activity, whereas the previous valuation, in my opinion, really didn't. The previous valuation was priced for as if the company was going to shut down or something. So that's my view. I remain positive, but obviously it's less slam dunk than it may have been back in December. Okay, now let's move on to something else. Take a quick look at Everyman. This is a premium cinema group. We've got some great films to look forward to over the next year. Of course, that's the main reason I read these results, to see what films are coming up. We've got Paddington in Peru. We've got the new Joker movie. We've got a Wicked movie. We've got Lion King, and we've got a Gladiator sequel. So we've got some great films coming up. So good to know. I do like to know what's on the schedule there, and that is it's obviously very important for the likes of cinema chains and maybe bowling alleys besides cinema chains. Similarly, but this stock has not been a wonderful performer, I must say, because it is tricky. We've seen cinema groups, high-profile cinema groups, have struggled in recent years, especially during COVID. And much like restaurants and other sort of leisure properties, there is a big capex bill, and there's a lot of fixed costs, salaries and energy, of course. And then you've got the throw in some economic cyclicality and throw in a cinema or a film schedule that can be hit or miss. You've got a lot of factors here that can mess with financial performance of cinema groups. So in the case of Everyman, it seems as if they've had a pretty good year. Admissions up 10%, revenue up 15%, so they've matched inflation. They mention adjusted EBITDA, which I would prefer if they didn't, because I don't see it as a relevant number for a capital-intensive business. Food and beverage spend has improved by 10%, so keeping up with inflation last year. And they say that they increased market share too. However, I suppose the bad news, which can't be ignored, is that operating profit, and this is on an adjusted basis, was very thin at £0.7 million. So this is one of those cases where the adjusted EBITDA is the hamburger you see in the advertisement, and the operating profit is the hamburger that you might get in your hand, and it does not look the same as the one that you saw in the advertisement. Um, they have gross cash, but they also have net debt, and that it would be another worry for me when I see a capital intensive, economically exposed business which is also financially leveraged with net debt. Uh, let's mention they've opened new cinemas. Fair enough, all good here. And they say that they are redefining how film is being consumed and therefore outperforming the wider cinema market. They have positive momentum and they are expecting 2024 to outperform 2023 due to a stronger film slate with those films I mentioned. And we have a CEO comment who says, guests are returning to our venues in greater numbers and spending more with us than they have in previous years. And the progress made is testament to the hard work of the teams in our venues and head office. So I remain interested in this stock. I think it's a nice one to keep track of, but unfortunately, the statutory profit numbers are just they just don't do it for me, I'm afraid. You can see the KPIs here. They say that they use the following key performance indicators in addition to total revenues to monitor the progress of the group's activities. So you can see that they're focused on admissions, average ticket price, food and beverage spend per head. I'm sure that makes perfect sense for a cinema operator to focus on these KPIs, and they focus on total revenues. But for financial investors, for value investors, I think most of us are more interested in seeing return on capital, return on equity, and margins rather than total revenues. So I think that is a key sort of cultural difference between sort of a cinema operator and a value investor. And if I scroll down here, I'll just see if I can get a quick look at the cash flow statement. Before I do, we've got adjusted EBITDA of 16 million pounds, and then we have depreciation and amortization of 13 million pounds. So you can see why, for a capital intensive business where, in my opinion, depreciation is a very real cost, there is no value in ignoring depreciation, and therefore there is no value in the adjusted EBITDA metric, in my view. And you can see that the depreciation dwarfs the other items here. And similarly in the cash flow statement, there's that depreciation number, 13 million. And you can see here that we've got a CapEx spend of 19, or let's say 18.6 million pounds of CapEx spend. So that's a real cost, and it can't be ignored, in my view. So let's move on from that. I remain interested in the stock. However, financial performance, in my view, still leaves something to be desired. Will we move on to the most read RNS? And you're very welcome, Steve, in the live chat. No problem. Let's move on to today's most read RNS. So here's the sort of top 10. You can see we've already looked at Sander, which is down there, number 9. And I just think it's interesting to see what people are reading. What is the stock that is catching people's imaginations? We've got this powerhouse energy group. I have tried to understand what they do. Honestly, I don't. But here's what they say. They convert non-recyclable waste into low carbon energy, and there is a powerhouse designed kiln which was manufactured by a Chinese company, and it's now being shipped to their technical center in Bridgend to meet a shipping vessel later this month. So This is the RNS which has captured the imaginations today. I had a look at Powerhouse's historic financials, and it seems as if they are or have been effectively pre-revenue, but hopefully that will change soon. The CEO says this is a huge milestone. We are delighted to achieve this given the issues and delays. We are looking forward to the completion, and he would like to thank shareholders for their patience. So I have, as I said, the historic financials here suggest a pre-revenue company. We'll see revenue here less than £1 million up until 2022. So hopefully now this signals a change, and maybe we'll see material revenues here in due course. Okay, that is the most read RNS on the Vox Markets website. Please, if you're enjoying the show, give me the thumbs up. It definitely helps, and it means I'm more likely to be here tomorrow. Just kidding. Okay, let's move on to Team 17. I do enjoy reading about video games companies. So these shares are down 4% today. Team 17, if you are a gamer, or if you were a gamer 20 years ago, you may remember that Team 17 was responsible for Worms, which was one of the most satisfying games of, I guess, the 90s, where you would blow up all your friends' army with using all sorts of weapons. So anyway, here's the final results for 2023. Possibly a little late to be reporting this in mid-April, but there you go. So they describe themselves as an indie games developer. So indie to me is a bit like an indie film studio. It's not your blockbusters. It's not Gladiator. It's not a Marvel film. It's a fairly low budget game, but it still has the potential to make a profit. And indie games developers can do reasonably well with if they develop, they can be reasonably well diversified. They can generate a decent profit, and you can see that Team 17 does have an adjusted profit before tax for 2023, but it does not have a statutory profit before tax. So we've got some significant impairments here. Adjusted EBITDA excluding title impairments impairments are one issue, and you can see that there's a long list of games here and apps. So I suppose that's the main attraction with indie games developers, that they're not sort of dependent on the success of one game, because they've not spent very much investing in any particular game. We could make an easy comparison with the likes of Frontier Developments, where they will invest heavily in one flagship game, and that flagship game will be launched on a particular date, and if it doesn't do well, then it is terrible news for the company. But I would say Team 17 doesn't have that problem, but they do have. They've got a range of games here that they've mentioned. They've got a back catalog, and that's another interesting point. The back catalog accounts for 71% of group revenues. Another very important distinction between an indie games developer and a developer of flagship cutting edge games. If you develop a flagship cutting edge game, you expect huge sales on day one. A bit like if you release a flagship movie, you expect opening weekend to be huge, and then you expect a big fall off. Same with video games. You expect huge sales at launch, and then a big fall off. Indie games, I don't think it works quite the same because I suppose there's less hype around the launch of an indie game. There is some hype, but then over time, through word of mouth, somebody will tell their friend, "Hey, I found this really cool little game. Let's play it," and you get this sort of slow burn. So interesting point here, and that does provide some stability to revenues for a company like this. Um, Look, I have a fairly positive impression of Team 17. Um, I don't know if I'd be in a mad rush to buy the shares, but it is certainly a credible video games publisher and developer, and well respected. And today's update is in line with market expectations. So look, could be worth researching in further detail. If you're interested in the sector, I'd certainly recommend getting stuck into Team 17 and having a look. They've got a decent pipeline. What more can I say? A decent company, could be worth researching in more detail. I like Team 17. Okay, let's move on to something else. Let's see if we can make sense of SuperDry. So SuperDry is down 32%. Let's see now. This RNS hasn't worked. Obviously, SuperDry market cap £5 million here. It's been struggling. I think we have talked about it in a previous. Yeah, we talked about it here 2 weeks ago when Dunkerton decided not to buy into it. So, yeah, SuperDry is probably not going to work out for shareholders. I think we can safely say that. And yeah, so I'll just tell you a little bit about today's news. They're planning to go private. They're planning to delist, and yeah. So the listing will finish soon, and basically, with the new equity raise, I don't think it's going to leave much for existing shareholders. And obviously, people don't like to own unlisted companies. So tough news there for SuperDry investors, but I think it was already baked in that the news wasn't going to be positive. So shareholders here will be left with unlisted shares under the new restructuring plan, and they say that if the plan is not implemented, that they will enter administration. So yep, sorry for anybody still holding that, but hopefully you were braced for impact, because the bad news has been trailed here for a while. Okay, that is SuperDry. Where will we go next? Will we have a little look at Hollywood Bowl? So these shares are unchanged today. Decent sized company now, £570 million. I think it's nice to have a look at this one since we've already covered the cinema group. So it's nice to look at bowling, because obviously they tend to go together on the same day. So we've got decent revenue growth here, 8%. We've got net cash of £41 million, along with an undrawn facility, and decent, as I said, decent sized company here now. 71 UK centres, 11 Canadian centres, and the pipeline continues to build across both geographies. So yeah, I mean, despite what I said previously about cinema groups, I must admit that Hollywood Bowl has been quite a good performer financially over the years, in my opinion, and sort of beat my own expectations. It sort of beat my own bias against capital intensive leisure facilities or leisure companies. So yeah, I've always been reasonably impressed and surprised in a good way by performance of Hollywood Bowl, and I I see little to dislike here in today's update. Canadian business has seen 8% like-for-like revenue growth on a constant currency basis, and as I said, the net cash, and they are confident about the outlook for the business. Although the economic backdrop remains challenging for consumers, they remain focused on offering a high quality and great value for money experience with broad appeal to all customer groups looking for leisure experiences to enjoy together. So yeah, I see very little to dislike here. I guess you could say I'm a fan of Hollywood Bowl. Wish them the very best, and they performed well. I mean, look at this profit and loss statement for September 2023. Revenue £215 million, pre-tax profit £45 million. Who could argue against that? An excellent performance, and you can see that return on capital employed in the last 2 years has been over 20%. So I don't know how they do it, but it's very, very impressive stuff. So yeah, congratulations to Hollywood Bowl on continuing to do well. Um, okay, now this show is going on for longer than usual, but we do have a little bit more to look at if we can get around to it. System 1 Group is up 1% today. Market cap £67 million, and they've got a trading update. This company used to be called Brain Juicer. It had a very funky website, and then they've kind of changed a lot over the years, trying to be more scientific. They've got this name System 1, and yeah, and I find it what I've found slightly strange is that they allow their consultancy okay, let's see if I can explain this. They've got other consultancy revenue which they have allowed to decline, but then within what they call platform revenue, they've got something that they call data-led consultancy. So it almost feels like, and I'm not saying that this is true, but it feels like they've changed what they call their consultancy revenue. They've got other consultancy, which is falling, and then they've got data-led consultancy, which is rising. And I find that a bit strange. I don't. I mean, I can kind of see what they're doing, but it almost feels like they could just scrap this distinction, honestly. But anyway, overall revenue has grown by 28% in FY 2024. So that's certainly impressive. And the management situation here got a bit volatile. There were calls for management to be changed and for people who were previously running it to get back in charge. I think that's all calmed down now. But here's the PBT, profit before tax, for March 2024 is expected to be £2.8 million, which is ahead of market expectations, a lot higher than the previous year. So that's good. They're back earning decent profits. It's a significant improvement on a company which did seem to be struggling. I suppose what I would point out is that if total revenue is £30 million and PBT is £2.8 million, what that says to me is that the company is not really a data sort of software-led business, or if it is, that it hasn't reached sufficient scale yet. Because what you want to see from a software business is enormous profit margins. You want to see something that looks like pure profit, and I suppose that's my difficulty with System One. Is I'm not clear on whether they are really a consultancy business or whether they've got a data product with consultancy attached to it, or whether the pure data project is really generating pure profits. It's just not clear to me. But I remain interested, and I hope they succeed. But for me, the profit margins here haven't, even with the big improvement in FY24, the profit margins here haven't taken off yet in a way that I'd like to see from something that was a real software-led business. So I've mixed views on System One, but it's an interesting stock. Still quite small, but market cap 67. I suppose it's that's a significant improvement on where it was. I suppose shareholders will be feeling very happy who held it over the last 6 months or so. They've certainly seen a big improvement. Good news for anybody who's been holding that one. Okay, let's move on from System One. I may need to keep some stocks in the back pocket for tomorrow because I don't want today's video to go on for too long. We have a quick look at GATC. So this one has the ticker GATC. So GATC PLC. So this is another recruitment stock. And as I've mentioned previously, my favorite recruitment stock by far is SDRY, which has the ticker STEM. I think I commented on Page Group yesterday. GATC much smaller than those I've just mentioned, only 32 million market cap. And we've got an update today, our interim results. See, revenue is down. We've got an operating loss. So it's sort of around break even on 188 million pounds of revenue. These numbers are effectively break even for H1. It's been brought to my attention that the net cash here is a significant chunk of the market cap. So if you're a value investor who likes companies where the cash covers the market cap, the net cash here is 22 million pounds against a market cap of 32 million pounds. So that may be of interest to value investors. Let's point out here again a point that I think is the most important point for people who want to invest in recruitment stocks. We've got contract net fee income down 3%, and we've got permanent net fee income down 36%. So it's the permanent recruitment that is extremely sensitive to market conditions. The contract recruitment is not so sensitive at all, because contractors are always getting their new contract. Even in a difficult economy, most contractors will roll off a contract and get a new contract. But it's totally different in permanent recruitment. You need economic positivity to sort of get people switching jobs, in great numbers. Without that economic positivity, you don't get people switching jobs, to upgrade to something better, you get people staying where they are. And so with permanent net fee income down 36%, that is an important sign of economic challenge. And it sort of highlights that, a vulnerability for GATC, that they are vulnerable to that problem. In terms of the outlook statement, they mention macroeconomic headwinds which have impacted demand and candidate sentiment across the recruitment sector and negatively affected performance. Page Group said the same thing. We continue to see permanent recruitment subdued in the short term, and our focus remains on growing our contractor base. As such, we expect full year underlying profit before tax to be in a range of 2.4 to 2.7 million pounds. And given that the market cap here is 32 million pounds, it wasn't pricing in profits that were vastly higher than that anyway. So especially when you consider that the market cap is in a sense covered by the cash balance to a great extent. So as I've said, this is not my favorite recruitment share, but I think it could be of interest to value investors who perhaps also who would just be interested in the cash balance and the potentially cheap valuation. So could be worth a look. So that's GATC. Okay, guys, we're at nearly 57 minutes. There's a little bit too much to cover today. Phil Curtis in the comments is asking about pets at home. Thank you for the suggestion. I haven't got anything for you on that today, but I have taken a note that it's a request, so something to keep an eye out for. Please hit the thumbs up if you've enjoyed the show. A bumper edition of Taking Stock today. Please subscribe to the channel, subscribe to Vox Markets, sign up on the website as well. It's a great website. And I will be back tomorrow, and I will potentially cover some of the stocks I didn't get to cover today, because today was an absolute deluge of news. But hopefully we got through a decent amount of it there, and hopefully your portfolio survived the day's news in good shape. So have a great day, everyone. And I'll leave you with the outro. Thanks very much for watching, and bye for now. Cheers.